We just lived through a fascinating at least year and a half as we are coming out of these aggressive interest rate hikes. You put the global pandemic before that. And the time period that we just went through over the last, let's say, 3 years is probably one of the most interesting economic periods that we have seen really in modern history. Many, many books will be written about it, and we will be talking about this time period for decades to come. Now, you may not be as interested or think it's as cool as I do, but I bet you do care about what your investments might do next year, how the job market's going to look, what the housing market's going to do. So, we're going to jump into this article right here from the Wall Street Journal. The most important debate on Wall Street is inflation licked, and start to try and understand what next year might look like. And more importantly, we are going to conclude by talking about why I think we are in such a very interesting situation right now, especially if we get a little recession next year, because I don't think a little recession next year might be what people think might be coming out of that. So we're going to get to that in a minute. All right, so let's jump into the charts on this. It's a very interesting read. So this is showing that the Federal Reserve has been trying, the reason we've been raising interest rates as aggressively as we did is to try and get inflation back below the Federal Reserve's target of 2%. You can see that we are getting closer here, but we haven't achieved it. It's going to take some time before, right? We're not going to see this plunge back below that Fed target, in my opinion. It's probably going to level out and kind of slowly come back down. I think they will get it there. I think the interest rate hikes that we've gone through are still lingering through the economy. I mean, interest rates are still very high right now. So no shock there. This is just going over kind of the same data. This was super interesting that the article talked about. It says that one of the reasons that inflation was so particularly bad during and through the pandemic was because the pandemic caused everyone to spend their money on the same things. Normally, one person's buying a refrigerator, another person's going on vacation, another person is enrolling their kid in kindergarten or something along that, and we're spending our money all over the place. But when the pandemic hit, everybody started buying webcams, everybody started buying things for their home. And then when the pandemic ended, people started traveling, right? So as a society, we were spending our money in very focused areas. And this chart is just showing you how core goods spiked and then came down, but services stayed higher longer because we started spending on them kind of towards the end of the pandemic. So a really interesting point around, if you're kind of in this mind, like how can we go from almost zero inflation, 1.5%, 2%, to 9, seemingly what was overnight, and then in all the way back down. Like, how does that work out? Well, if you think about how the pandemic impacted society, it's not that hard to understand. This is talking about labor productivity being up, not super interesting there. Real GDP. So this is really just showing that the impact on the economy has been there. The economy has slowed down. They show, over the last couple of quarters, real GDP has come down. Of course, we got this big outlier last quarter. We don't know whether we're going to see another one like that. This is what they're predicting, but they were predicting that last quarter. So it'll be interesting to see whether we continue to see GDP kind of turn down. Labor force quits coming back down again. Still relatively high in that we still have some movement in the labor market, but it is slowing down, which is important to keep inflation down. This was interesting. So this big purple line was Zillow rents. So effectively, we saw rents spike during the pandemic, and then housing kind of come up afterwards as that has kind of shifted through there. And then it does talk about a little bit of pessimism around job openings are still really high, meaning the labor market is tight. So wage growth could still be really aggressive, which would harm inflation. Well, would make inflation worse. And then it's talking about employment costs and things along those lines. A couple other things here. I didn't think there was a ton of interesting things. So now I want to move on to the interest rate story very specifically, because it's going to weigh in very heavily to this idea of what happens if we get a little recession next year. Um, the 10-year Treasury, is at 4.1%. Just in October 19th, it was almost 5%. We've seen an 18% reduction in the 10-year Treasury over a month and a half when the Fed has done nothing to the actual Fed funds rate, the interest rates during that time. We've seen it come down that dramatically. Why is this significant? This is significant because this means there's a lot of money that is effectively being bet on or being invested in the idea that interest rates are going to come down next year. And if you look at things like futures contracts and a bunch of things that are probably beyond the scope of this, you can see that most of that money is assuming interest rates are going to start coming down around May. Now, they don't know, and I certainly don't know, and I'm not telling you that interest rates are going to start coming down in May, but there's a lot of money being bet that interest rates are going to start coming down, mid to early next year. And that is going to have a dramatic impact on a lot of things. We don't know whether the economy is going to come roaring back after that. But it leads into this idea of, if, like this was showing, GDP does continue to kind of straggle down, or is it right here, and we eventually get indicators that a little recession might be coming, that would often be indicators there would be like a substantial rise in unemployment, GDP really starting to struggle, get down towards zero, negative, along those lines, then we that could signal we are going to see the fabled recession we've been waiting on for 2 years is actually going to materialize. The difference of that materializing next year and, let's say, last year or this year when we kind of had expected it, in my opinion, is the fact that the Fed has interest rates high enough now that if they see a down and inflation is under control, if they see a possible recession, they could aggressively cut interest rates, which would have a dramatic impact on the stock market and the bond market. We could actually see the stock market and the bond market pop, do well, if we see a small recession on the horizon. Because if interest rates drop, then old bonds become more valuable because you bought them at a higher interest rate. So bond face values, or trading values, pop, and then the stock market has been waiting for interest rates to come down for a while. So it's very conceivable to see that we can see the stock market pop. It's odd that if we do get the no landing, as people have been talking about, where we don't get a recession, the markets may just kind of meander next year. It could be up, it could be down. It's really tough to kind of understand that because it's going to be trying to predict 2025. But if we see a dramatic drop in interest rates caused by a little recession, it could be pretty dramatic. Now, if you want to understand the story behind the story, which I think is this interesting thing about how the Fed went through this, then this video here goes through that story behind the story and also talks about how, although this time period is super interesting, it's really not that abnormal when you compare it to all the other abnormal events that we saw through history. So, great video to watch. I hope it's been informative, and I will talk to you soon. Thank you.